Before we get started, I just want to give a huge shout out to Bill Cara for putting together these incredible Navigator reports.
Yeah.
You can find a ton more of his insights over at billcara.com.
You bet.
We'll remind you again at the end, so no need to rush for a pen right now.
Okay.
Okay. So let's dive into Navigator report number 7, covering the week of February 17th to 23rd.
All right.
It's especially interesting to see how things have developed since his week 6 report.
Yeah.
We're seeing some major market jitters thanks to those looming tariffs.
Uh-huh.
Gold is absolutely shining as a safe haven.
Oh, yeah.
And Bill Cara is hinting at a potential stock market crash on the horizon.
It's fascinating to see how these global trends are playing out against the backdrop of what's happening politically and economically.
It really is. One thing that stood out to me was the performance of commodities.
Right.
There were some big swings this week.
Yeah, oil prices remained fairly flat year to date and even dipped a bit this week.
Okay.
But then you have natural gas,
Yeah.
which jumped nearly 15%. Wow.
A pretty dramatic move.
Yeah.
Bill Cara attributes this to strong demand coupled with some supply chain issues,
Right.
which is something we've been seeing across the board.
And even with all the uncertainty around tariffs, copper is still holding strong.
Right.
Up over 16% since the beginning of the year.
That's right. It seems like strong industrial demand is outweighing those tariff concerns.
Okay.
But where things get really interesting is gold.
Yeah.
It hit a high of nearly $3,000 an ounce this week
Wow.
and is up 12% year to date.
Huge.
This is definitely a case of investors seeking a safe haven in times of uncertainty.
When you look at the performance of global equity indexes,
Right.
it's a bit of a mixed bag.
We're seeing indexes down in Australia,
Okay.
Japan, and Germany.
Okay.
On the flip side,
Yeah.
the Hong Kong Hang Seng Index just keeps climbing.
Really?
It gained another 3.5% this week on top of a 7% gain last week.
Wow.
Out of the 20 markets Bill Cara tracks.
Hong Kong is the clear winner across all time frames, 1 month year to date. And even looking back over the past year,
What about some of the other markets?
well, India's BSE Sensex index is looking technically weak right now.
Okay.
And while Brazil's Bovespa index saw a 2% gain this week, its performance for the year has been pretty middle of the road.
Okay, let's shift our focus to the U.S. large cap scene.
Okay.
What are we seeing there?
Here in the U.S., it seems like the NASDAQ is lagging behind a bit.
Okay.
But other major indexes are showing strength. The S&P 500 edged up slightly,
Okay.
but the Dow took a bit of a hit,
Uh-oh.
its biggest drop in 4 months.
Why is that?
Bill Cara attributes that dip to United Health, UNH,
Okay.
which dropped almost 11%.
Wow.
Investors seem to be spooked by those ongoing Department of Justice investigations.
Let's talk about some of the broader economic and geopolitical factors at play here.
Okay.
Inflation is a big one.
Sure.
It jumped this week, and consumer expectations are up to 4.3%.
Those tariff fears, combined with the 10-year yield nearing 5%, are definitely adding fuel to the inflationary fire.
Okay.
Analysts seem to think this is a short-term spike, but that's a big if.
Yeah.
Bill Cara points out that a sustained stock market crash could actually have the opposite effect,
Oh, wow.
pushing us toward deflation, similar to what happened back in 2008.
It makes you wonder, how is the Fed planning to react to all of this?
For now, they're holding steady on interest rates.
Okay.
But there's definitely talk of rate cuts coming in mid-2025. Of course, that all depends on what happens with inflation.
Yeah.
If it keeps climbing, those rate cuts might be put on hold.
Right.
Bill Cara doesn't expect any movement from the Fed until mid-2025. Unless, of course, we see a market crash.
And then there are those tariffs, which
Right.
seem to be on everyone's mind.
Yeah.
What's the latest on that front?
Things are getting pretty tense between the U.S. and Canada. Remember, there's a March 4th deadline for steel and aluminum tariffs unless those exemptions are put back in place.
Right.
And while broader tariffs are on hold for now, they haven't been fully canceled.
Right.
So the threat is definitely still looming.
Yeah.
And Canada isn't backing down. They're taking action, both diplomatically and economically, to counter those
It
tariffs.
sounds like a recipe for disaster.
Yeah,
Not only economically,
Right.
but also politically.
absolutely.
What does Bill Cara have to say about investing in such a volatile climate?
Bill Cara is urging investors to tread carefully.
Okay.
He's warning that we could be in the very late stages of a bull market. A sobering thought for sure.
Yeah.
He's suggesting that investors take a hard look at their portfolios
Okay.
and seriously consider selling anything they're not comfortable holding on to.
Wow.
In fact, he mentions that he's in wait mode himself.
Really?
He's even on the verge of issuing a new market crash warning.
Okay, so Bill Cara is definitely waving a red flag here.
Yeah.
This seems like a big shift from the more optimistic tone of his Week 6 report.
You're absolutely right. Both reports highlight the potential for a market downturn
Okay.
and emphasize cautious investing,
Mm-hmm.
but the overall tone has definitely shifted.
Yeah.
It's interesting to see how the tariff situation,
Right.
which seemed closer to a resolution in week 6,
Yeah.
has escalated into a much more contentious battle.
And we're seeing this reflected in market performance,
Yep.
with sectors like gold continuing to gain strength
Uh-huh.
and areas like consumer discretionary remaining weak.
One thing that was brand new in this Navigator report
Oh, yeah.
is a section dedicated entirely to tariffs.
That was really helpful.
Yeah.
I think a lot of people, myself included, don't really understand what tariffs are,
Right.
how they work, and why they're such a big deal.
That's a great point, and a good place to wrap up part 1. Join us after the break for part 2, where we'll dig into the impact of tariffs and explore Bill Cara's insights in more detail.
That's good.
Welcome back. Before the break, we were talking about the new tariff section in Bill Cara's Navigator report. This report actually provides a really good explanation of what tariffs are and why they matter.
It's a bit of a history lesson, too, which I found interesting.
It is tariffs, which are essentially taxes on imported or exported goods, have been around for centuries. In ancient times, they were a major source of revenue for governments. Even the Greeks and Romans used them. Things started to shift towards free trade in the 18th century, but as we're seeing now, tariffs are definitely making a comeback.
And it's not just history repeating itself. There's a new layer of complexity with the rise of globalization and intricate supply chains. What really struck me was Bill Cara's point about the ripple effect tariffs can create, impacting not just costs, but even political relationships.
Absolutely. The current standoff between the U.S. and Canada is a prime example. Those tariffs are already impacting businesses and consumers, and the threat of a full-blown trade war adds a whole other layer of uncertainty to the mix.
And that uncertainty is reflected in the market jitters we're seeing. I'm curious, what does Bill Cara have to say about navigating this landscape? Is he offering any specific advice beyond proceeding with caution?
He is. This is where Bill Cara's philosophy of out-of-Fox Wall Street comes in. He's urging investors to think for themselves, to break free from the Wall Street echo chamber, and to stop relying on those humongous banks and brokers to tell them what to do.
So it's about taking ownership and educating yourself.
Exactly. He's not just handing out stock tips. He's empowering investors to develop their own strategies based on sound principles. He's a strong advocate for investor independence.
In the report, he does highlight a few strategies he's using, like the Cara 100. Can you tell us a bit more about that?
The Cara 100 is a curated list of 100 high-quality companies that Bill Cara believes have strong, long-term growth potential. He looks for companies with solid fundamentals like revenue growth, profitability, and strong financials. He's not chasing the latest fads. He's looking for companies that are built to last. It's also a really helpful framework for anyone trying to evaluate companies on their own.
It's like a peek inside the mind of a seasoned investor. He also talks about dollar cost averaging, or DCA. I think a lot of people have heard this term, but might not fully understand what it means or how it works.
DCA is a simple yet powerful strategy. You invest a fixed amount of money in an asset at regular intervals, regardless of the price. It's essentially a way to average out your cost per share over time and avoid making emotional decisions based on those short-term market swings.
So instead of trying to time the market, you're consistently investing over time, riding out those peaks and valleys.
Exactly. Of course, no strategy is perfect, and Bill Cara acknowledges that with DCA, you might miss out on some gains if the market is consistently trending upward.
It's all about finding the right balance between risk and potential reward. Bill Cara definitely provides a lot to think about. Now let's get back to the report. Bill Cara delves into specific market data, including a breakdown of bond performance and key economic indicators. Where should we start?
Let's look at what Bill Cara is seeing in the bond market. He points out that high-yield spreads have continued to widen, reaching about 475 basis points. This is up from 450 the previous week, and suggests that investors are getting a bit more skittish, especially with those defaults we're seeing in commercial real estate and the uncertainty surrounding tariffs.
So we're seeing those ripple effects, again, with concerns in one area impacting other parts of the market.
Exactly. Moody's has also been making some moves, though. Those $120 billion in leveraged loans downgraded to junk status earlier this year haven't seen any major additional downgrades this week. But there was good news for GE Aerospace. Moody's upgraded their senior unsecured ratings to A3 and gave them a positive outlook.
Interesting. It seems like there's a lot of focus on risk right now. What else did Moody's do?
Well, they also assigned a rating to a new class of CLO refinancing notes issued by KKR CLO 35. Limited CLOs, or collateralized loan obligations, are basically bundles of corporate loans that are packaged together and sold to investors.
Okay, I think I'm starting to understand how this all fits together. What about yields?
Bill Kara mentions that he doesn't have the time to go into a deep analysis of bond yields in this report, but he does emphasize the importance of keeping an eye on them as a key indicator of market sentiment.
He does recommend a specific ETF for investors who want exposure to investment-grade corporate bonds. The iShares iBox LBox Investment Grade Corporate Bond ETF, ticker symbol LQD.
And to add to that, ETFDB, a website that specializes in ETF research, calls LQD a very useful tool for long-term investors. They suggest it could even be a core component of a buy and hold strategy, especially for investors building a diversified bond portfolio.
So if you're looking for a relatively low-risk way to get into bonds, LQD might be worth considering. Speaking of risk, what does Bill Kara have to say about the current economic climate and how that translates to capital market prices?
He emphasizes that understanding economic reports and how they impact capital market prices is absolutely essential. He compares these reports to vital signs, giving us a glimpse into the health of different economic sectors and helping us predict future trends.
That makes sense. And Bill Kara is particularly focused on U.S. consumer data reports, right?
Yes, consumer spending is a major engine for economic growth. So when consumers are confident and spending freely, it's good news for businesses and the overall economy. But if that confidence falters, it can have a ripple effect throughout the entire system.
That's a lot riding on the consumer.
It really is. That's why Bill Kara closely watches reports like the Consumer Confidence Index. He's also looking at reports on GDP, housing starts, existing home sales, and a whole range of other indicators to see how consumers are feeling and how that translates into economic activity.
It's like a giant puzzle, and Bill Kara is helping us piece it all together. He mentions the daily economics calendar on investing.com as a valuable resource for staying on top of these reports.
Investing.com highlights those key events and provides links to all the latest data, so it's a great place to start. But Bill Kara doesn't just rely on government reports. He also looks at independent analyses, like the commentary from Rick Davis at the Consumer Metrics Institute.
Why is Rick Davis's perspective so valuable?
He's been doing incredible work in this area for years, and his insights provide a really valuable counterpoint to those official government numbers. He's offering a different lens through which to view the data. While his website is free to use, members can subscribe to premium reports for an even deeper dive into consumer market trends.
It always helps to have multiple perspectives. Speaking of multiple perspectives, let's see what Bill Kara has to say about the global equity market.
It's been another volatile week with some markets down and others up. As we discussed earlier, Australia, Japan, and Germany saw their markets dip.
But Hong Kong continues to be the outlier, defying gravity with another impressive gain this week.
The Hang Seng Index soared another 3.5%, making it the strongest performer out of the 20 international markets Bill Kara tracks. It really is remarkable.
On the other side of the spectrum, India's BSE Sensex Index is looking pretty weak.
Yes, it is. And Brazil's Bovespa Index, while up 2% this week, has seen pretty average performance so far this year.
Okay, so the takeaway here is that volatility is the name of the game, and it's important to stay informed and be prepared for anything. Now let's talk about how Bill Kara uses technical analysis to evaluate markets.
This is where things get a bit more in-depth. He talks about using indicators like the RSI, or Relative Strength Index, and the MACD, or Moving Average Convergence Divergence.
I know those are popular indicators, but can you give us a quick refresher on how they work?
The RSI measures the speed and change of price movements to help determine whether an asset is overbought or oversold. It's essentially a momentum indicator that can help signal potential turning points.
So it's like a gauge for market sentiment.
Exactly. And then you have the MCD, which is a trend-following indicator. It uses two moving averages to highlight shifts in momentum and potential buy and sell signals.
Bill Kara uses both investing.com and stock charts for his technical analysis.
Yes, he does. And he points out that while the two platforms use slightly different calculations for the RSI, the results are usually very similar.
So you're getting a pretty consistent picture. But he also stresses that these indicators are just that, indicators. They're not foolproof predictors of future price movements.
Absolutely. It's important to remember that technical analysis is a tool, not a crystal ball. Bill Kara also highlights the importance of using multiple indicators together to get a more complete picture of the market. For example, he uses a monthly data chart from stock charts to show the long-term trend using the RSI momentum above the 70 line as a cautionary signal.
So when the RSI crosses above 70, that's a sign to be wary.
Yes, it's like a yellow flag telling you to proceed with caution. Then he'll switch to the MACD to look for a trend reversal, which could be a sell signal.
Okay, so you've got the warning from the RSI, and then you're looking for confirmation from the MACD. It's
Yeah.
a two-step process.
Exactly. And it underscores Bill Cara's overall message of being strategic disciplined and not getting swept away by the market's emotions. Speaking of emotions, this is where his emphasis on independent thinking really comes in. He urges investors to develop their own strategies and not blindly follow the herd or the advice of those big banks.
I love that. It's so easy to get caught up in the hype and make emotional decisions, especially when everyone around you seems to be doing the same thing.
It is, and Bill Cara stresses that investors should approach the market with the same critical thinking as legends like Warren Buffett and Peter Lynch. He's not saying it's easy, but it's definitely possible with time and effort.
It's about learning to think for yourself and making informed decisions.
Right. And he cautions against blindly following the advice of those big banks and brokerage firms because at the end of the day, their interests aren't always aligned with yours.
He even shares that great story about his yachts, Dream Merchant, and Time and Space to illustrate this point.
Yes, his first yacht, Dream Merchant, reflected his time working within the system, while his next yacht, Time and Space, symbolizes the freedom he gained by breaking free from Wall Street and charting his own course.
It's a powerful reminder that we all have the ability to define our own path. It's not about getting rich quick. It's about achieving financial independence and living life on your own terms.
Couldn't have said it better myself.
Okay, let's get back to some specific data points from the report. Bill Cara spends a good amount of time analyzing the S&P 1500 index.
Right. And for those who might need a refresher, the S&P 1500 is a broad market index that encompasses large, mid, and small cap stocks. Essentially the S&P 500, 400, and 600 combined. It gives us a comprehensive look at the overall health of the U.S. stock market.
He provides a whole list of specific S&P 1500 indexes to watch.
He does things like the S&P Composite 1500 Index, the S&P 1500 Advanced Decline Percent, and several others that track the percentage of stocks trading above their moving averages.
Those are all valuable metrics for assessing overall market trends. He also mentions the SPDR portfolio, S&P 1500 Composite Stock Market ETF, ticker symbol SPTM.
SPTM is an ETF that tracks the performance of the S&P 1500 index. So if you're looking for a simple way to invest in the broad U.S. market, SPTM is one option. But it's important to do your research and understand the risks involved.
Speaking of risk, Bill Cara's analysis of the S&P 1500 Advanced Decline Percent reveals something interesting. He compares it to the NYSE index using hourly data and finds that while the market has been rising, fewer stocks are participating in that rally.
Yes, he calls this narrowing market breadth. And it's something to keep in mind. Even when the major indexes are hitting new highs, it's crucial to look beyond the headlines and see what's really driving those gains. This ties back to his emphasis on independent thinking and not just blindly following the crowd.
It's about looking at the whole picture, not just a single data point. So what does Bill Cara have to say about the NASDAQ?
The Nasdaq is often seen as a proxy for the technology sector, and tech stocks have been on a bit of a roller coaster ride lately. We've seen some big winners and some big losers.
Like Airbnb and DraftKings, which both saw their share prices surge after strong earnings reports.
Right. And then there's Trade Desk, which took a tumble after missing revenue estimates. HubSpot seems to be doing well, though their share price is up after exceeding earnings expectations and setting some ambitious goals for AI integration.
It's a mixed bag, but it seems like AI is becoming a major focus for many tech companies. I'm curious to see how that plays out. What's Bill Cara's overall take on the NASDAQ?
He's been doing a deep dive into both daily and hourly data charts. He points out that the NASDAQ has actually been underperforming the NYSE Composite Index since last July.
So despite those big winners, tech stocks as a whole are lagging behind the broader market.
That's right. It's definitely something to keep in mind if you're considering investing in the tech sector. Now let's shift our focus to what is probably the most widely followed stock market index in the world, the Dow Jones Industrial Average.
The Dow is a price-weighted index that tracks the performance of 30 large U.S. companies. It's a snapshot of those iconic blue-chip companies that have been around for a while.
Right. Bill Cara provides a really comprehensive overview of the Dow 30 in his report, including links to essential information on each company charts, technical analysis. It's a wealth of information. He does highlight that the Dow took its biggest hit this week in about 4 months, attributing that drop to United Health's, UNH, nearly 11% decline. It seems investors are concerned about those ongoing Department of Justice investigations.
It's a reminder that regulatory scrutiny can definitely have a negative impact on stock prices. And looking at the Dow 30-point and figure chart, Bill Cara points out that the index is struggling to break through a double top, which could signal that it's running out of steam.
Okay, so that's definitely something to watch closely.
Um,
Now let's talk about the Dow Jones Transportation Average, or DJTA.
The DJTA tracks the performance of companies involved in the movement of goods and people. It includes everything from airlines and trucking companies to railroads and shipping companies. It's a key barometer for overall economic activity.
And it's an important part of what's known as Dow theory,
Right.
right?
Yes. Dow theory is a set of principles for technical analysis that was developed by Charles Dow, the founder of the Wall Street Journal. One of the key tenets is that the DJIA and the DJTA must align to validate a trend. So if the DJIA is hitting new highs, but the DJTA is lagging behind, that could signal a problem.
It makes sense. If companies are producing goods, but those goods aren't being shipped, it suggests a weakness in the overall economy. Bill Cara is a big believer in Dow theory.
He is. He provides a detailed breakdown of the DJTA in the report, including a list of the 20 companies included in the index, plus links to their stock valuations, financial strength ownership, and overall performance.
He really covers all the bases.
He does, and he talks about how the DJTA has been impacted by events like the inverted yield curve we saw in 2022, which signaled a potential recession.
Yeah.
He also touches on those persistent global supply chain issues that have been causing problems for so long.
It seems like supply chain disruptions are the gift that keeps on giving.
It does feel that way sometimes. But Bill Cara also acknowledges the positive potential of emerging technologies in the transportation industry. He specifically mentions self-driving cars and drones, which are already starting to make their mark.
It's fascinating to think about how technology will continue to reshape industries in the years to come.
It really is. Now let's shift gears again and talk about Bill Cara's approach to generating those buy, sell, and hold ratings that he includes in the Navigator report.
This is one of my favorite parts of the report. It provides such great insight into how he analyzes stocks, commodities, and other assets.
Bill Cara emphasizes that these ratings aren't trading signals, but rather conditions to be aware of. He explains that the first time a rating changes, that shift could be considered a signal. But after that, it's more of a reflection of the market environment and its potential for change.
So context is key. It's not just about reacting to a single rating, it's about understanding the bigger picture.
Exactly. He uses the example of a bear market, which is classified as a 20% or more price decline from a recent high. Just because a stock is in a bear market doesn't mean you need to sell it right away. It just means the overall market is in a downtrend.
So it's about being patient and looking for those technical indicators to signal a potential reversal before making a move.
Precisely. Bill Cara also talks about how different investors and traders use various time horizons for technical analysis. Day traders typically focus on hourly and minute data charts, while investors often prioritize daily and weekly data. He cautions against day trading, arguing that most individual investors don't have the resources or expertise to compete with those big institutions and hedge funds that dominate that space.
He's not pulling any punches.
He's not. He calls most day traders delusional for thinking they can consistently beat the market.
It's blunt, but I appreciate his honesty. He's not sugarcoating the realities of the market,
He's trying to save people from making costly mistakes.
which I think is commendable.
Mhm.
Okay, let's talk about another tool Bill Cara uses to analyze market trends, sector-specific ETFs.
Right. He provides an overview of the 11 U.S. sector ETFs and notes that 6 of them actually ended this week as losers. This suggests that the market is starting to get tired.
That's not a great sign. Which sector was the biggest loser?
The biggest loser this week was consumer discretionary, while energy was the biggest winner.
Interesting. It's almost like a microcosm of the anxieties and opportunities in the broader market.
Yeah.
What about year-to-date performance?
Well, consumer discretionary is the only sector close to a zero gain so far this year. All the other 10 sector SPDRs have solid 2-month gains.
So overall, it's been a good start to the year for most sectors, but there are definitely some warning signs flashing. Bill Cara sees these industry-specific ETFs as valuable tools for understanding those broader economic trends and finding potential investment opportunities.
That's right. For example, a decline in the consumer discretionary sector ETF might suggest weakening consumer confidence. On the other hand, if the industrial ETF rallies, that could signal economic expansion.
So you're looking at the performance of these ETFs as clues about the health of the overall economy.
Exactly. Bill Cara uses this information to help him contextualize the performance of individual stocks. It's about connecting the dots and seeing the bigger picture.
Bill Cara also uses industry-specific ETFs for what he calls sentiment and momentum analysis. What exactly does that entail?
He's looking for signs of shifting investor sentiment. So high trading volumes or significant price movements in a particular sector ETF can indicate a change in how investors are feeling about that sector. It's another way to gather those clues about what the market is thinking.
Fascinating. It's almost like you're getting a glimpse into the collective mind of the market.
That's a great way to put it. And Bill Cara believes understanding these trends is crucial for making smart investment decisions.
Okay, I'm getting the sense that Bill Cara is all about putting the pieces of the puzzle together.
He is. It's not just about looking at a single chart or a single indicator. It's about understanding the broader context and seeing how everything fits together.
Let's move on to gold miner stocks. Another area where Bill Cara is seeing some interesting trends. He notes that there's been some recent selling pressure in this sector as the U.S. dollar has strengthened.
That's a common dynamic. When the dollar rises, gold tends to fall and vice versa.
Bill Cara sees this selling pressure as a short-term phenomenon, though. He still believes in the long-term bull case for gold miners.
He does. He sees it as a potential buying opportunity for those long-term investors who believe in the story of gold as a safe haven asset.
He uses a chart of the VanEck Vectors Gold Miners ETF, ticker symbol GDX, to illustrate this point.
Right, and that chart reveals something interesting. The RSI momentum indicator suggests that gold miners are oversold, which would typically be a bullish signal. However, the MACD trend indicator is still bearish.
So mixed signals, but Bill Cara seems to think the scales are tipping towards the buy side.
He's calling it an accumulation alert, suggesting that now might be a good time for patient investors to start buying those dips.
Okay, let's move on to the industrial sector. Bill Cara notes some recent losses in this area, particularly among companies like Quanta Services, Lockheed Martin, RTX, and Delta Airlines.
It hasn't been a great week for industrials. Quanta Services and Lockheed Martin in particular have taken a pretty big hit over the past month.
That's concerning. Any insight into why?
Bill Cara doesn't go into detail about the specific reasons for these declines, but he does point out that there hasn't been any major news in the industrial sector this week. So it seems more like a broad-based sell-off, perhaps driven by those overall market jitters we've been discussing.
So a case of a rising tide lifts all boats, but the tide's going out right now.
Yeah.
Is he predicting a continued decline?
Not necessarily. He highlights the current narrative, which suggests that earnings growth in the industrial sector should be strong in 2025, particularly in areas like aerospace, defense, airline services, and transportation. So it's possible this is just a blink on the radar, a short-term pullback within a longer-term uptrend.
He also looks at the Industrial Select Sector SPDR Fund, ticker symbol XLI.
Yes, and that chart shows a recent downtrend, though the XLI remains above its long-term moving averages. This reinforces the idea that it could just be a temporary dip.
Bill Cara also tracks a watch list of industrial stocks. What's he seeing there?
Unfortunately, many of them have suffered significant losses this week, mirroring the decline we've seen in the XLI. It seems that pain is being felt across the industrial sector.
And then there's consumer discretionary. Bill Cara believes this sector is being hit particularly hard by the tariff situation.
That makes sense. When there's talk of tariffs and potential trade wars, consumer confidence tends to take a hit. People become more cautious about their spending, especially when it comes to those non-essential items.
This is reflected in the recent performance of the Consumer Discretionary Select Sector SPDR Fund, ticker symbol XLY, which has taken a beating lately.
That's right. And it's not just the ETF. A lot of the individual stocks in Bill Cara's consumer discretionary watch list are also down sharply. It seems like investors are voting with their feet and moving away from this sector for now.
We talked about tech earlier and how it's been a bit of a mixed bag. What's the latest there?
The technology sector continues to be volatile, with some companies performing well and others struggling. Bill Cara points out that the Technology Select Sector SPDR Fund, ticker symbol XLK, has been relatively flat recently.
So not much movement overall. But that doesn't mean there aren't some interesting stories within the sector.
Exactly. Bill Cara's watch list shows some divergence. Apple and Nvidia have had strong weeks, but Vertiv Holdings took a pretty big hit. It seems like the winners and losers are becoming more pronounced.
Bill Cara seems to think that tech will continue to be a volatile area in the coming months, especially as investors try to figure out what's happening with the economy and interest rates.
I think that's a fair assessment. There's still a lot of uncertainty in the air.
Okay, let's shift gears to the real estate sector. Bill Cara provides a pretty in-depth look at the Real Estate Select Sector SPDR Fund, ticker symbol XLRE. What's his take?
He's noticed a downtrend in XLRE, recently attributing it to the rising interest rate environment.
That makes sense. When borrowing becomes more expensive, it can definitely cool down the real estate market.
Exactly. The individual stocks on his real estate watch list are also down sharply, so it looks like a broad-based decline across the sector.
He also spends some time talking about REITs, or real estate investment trusts.
Mm,
I think a lot of people are curious about REITs, but not everyone fully understands what they are or how they work.
that's a good point. A REIT is basically a company that owns, operates, or finances income-producing real estate. Think office buildings, shopping malls, apartment complexes, that kind of thing.
So it's a way to invest in real estate without actually having to buy and manage properties yourself.
Exactly. And one of the benefits is that REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends.
Hmm.
So for income-oriented investors, REITs can be a pretty attractive option.
They can be a good source of income, but Bill Cara cautions against chasing those high dividend yields.
He's right. It's tempting to get lured in by a juicy dividend, but if the REIT's stock price drops, you could end up with a negative total return even with that dividend.
So it's all about the total return, not just the yield. What else does Bill Cara have to say about REITs?
He emphasizes the importance of diversification.
Yeah.
Don't put all your eggs in one basket. Spread those investments across different types of REITs that focus on various segments of the real estate market. This can help to mitigate some of that risk.
Makes sense. Bill Cara also takes a look at the Dow Jones U.S. Real Estate Index, ticker symbol DJUSRE.
He does, and that index shows an interesting trend. The U.S. real estate market has been strong for quite some time, enjoying a multi-year uptrend,
Right.
but there are signs that it's starting to cool off.
So it's a sector to watch closely. Bill Cara provides a helpful list of other real estate indexes and ETFs to track as well, which is a great resource for investors who are interested in this space.
He does. He includes global indexes, REIT ETFs, and even an ETF that tracks the performance of mortgage REITs.
Okay, let's dive into another area that Bill Cara covers, one that's been getting a lot of attention lately. Artificial intelligence, or AI.
AI is a game changer with the potential to revolutionize countless industries. Bill Cara believes this is one of the most exciting areas to watch, and he provides a list of AI and robotics ETFs for investors to consider.
He mentions the Global X Robotics and Artificial Intelligence ETF, ticker symbol BOTZ. That sounds intriguing.
He also includes helpful links to stock charts and FinViz, which are websites that provide all kinds of data and analysis on stocks and other assets.
Okay, so he's giving investors the tools to do their own research, which aligns with his philosophy of empowering individuals.
Exactly. Now, he also digs into the idea of physical intelligence, which he sees as a key component of AI.
I've heard of artificial intelligence, but what exactly is physical intelligence?
It's the ability of a machine to interact with the physical world. Think of robots that can move around and manipulate objects, or self-driving cars that can navigate complex environments. Bill Cara believes this ability to interact with the real world is essential for AI to reach its full potential.
It's like taking AI from the theoretical realm into the real world, which makes sense if you want it to have a tangible impact. Which companies are leading the charge in AI and physical intelligence?
Bill Cara highlights companies like Tesla, IBM, Intuitive Surgical, Baidu, Alibaba, and Tencent Holdings, all big names making huge investments in AI research and development.
He's also bringing up some thought-provoking geopolitical implications.
That's right. Bill Cara points out that AI has the potential to create new tensions between nations, and he highlights a recent speech by U.S. politician J.D. Vance, who argued that the U.S. needs to take steps to protect its national security as China's AI capabilities grow.
So AI is not just a technological advancement, it's a geopolitical game changer as well.
It is, and Bill Cara encourages investors to stay informed about these developments and to consider the potential risks and opportunities AI presents. Speaking of exciting yet potentially risky areas, let's talk about Bill Cara's thoughts on Bitcoin, cryptocurrency, and blockchain.
This is a world that's full of both potential and hype, which can make it difficult to navigate. What does Bill Cara have to say about the current state of the cryptocurrency market?
He starts by acknowledging that Bitcoin has been on a wild ride lately, plummeting to a 3-week low before bouncing back somewhat. It's a volatile market driven more by speculation than fundamentals, and Bill Cara attributes some of this recent volatility to trade war fears sparked by tariffs on those Mexican, Canadian, and Chinese imports.
So everything's connected. What's happening in one area of the market can have ripple effects across the board. What about other cryptocurrencies?
Ethereum and other altcoins have seen even sharper declines than Bitcoin, so the pain is being felt across the crypto space. Bill Cara does provide a list of Bitcoin and cryptocurrency ETFs for investors to consider, including the Grayscale Bitcoin Trust, ticker symbol GBTC.
So there are options for investors who are interested in getting into this space. But I imagine Bill Cara would urge caution.
He absolutely would. He stresses that cryptocurrencies are highly speculative assets, and their prices are driven more by sentiment and momentum than by underlying fundamentals.
It's easy to get caught up in the hype, but it's important to remember that crypto is still a relatively new and unproven asset class.
Exactly. And Bill Cara encourages investors to really understand the dynamics of the market and the inherent risks before jumping in. He acknowledges that blockchain, the technology underlying cryptocurrencies, has transformative potential. He explains it as a distributed ledger technology that enables secure and transparent transactions.
I know blockchain is a big deal, but I'm not sure I fully understand how it works.
Think of it this way. Instead of having one central authority like a bank controlling the ledger, the record of transactions is replicated and distributed across a network of computers. This makes it very difficult to tamper with those records because any changes would have to be made on every single copy of the ledger.
Okay, so that's where the security comes in. It's like a digital fortress.
Exactly. And Bill Cara believes blockchain has applications far beyond finance, everything from supply chain management and voting systems to healthcare. It really could be a game changer.
He also breaks down the distinctions between Bitcoin, Ethereum, and other altcoins.
Yes, and he stresses the importance of understanding the specific characteristics of each cryptocurrency before investing Bitcoin, as the original cryptocurrency is still the biggest player, but it's not the only game in town. Ethereum, for example, is a platform for building decentralized applications, and altcoins encompass all the other cryptocurrencies out there.
Okay, so it's not a one-size-fits-all market. You really need to do your homework. Speaking of doing your homework, Bill Cara dedicates a section of the report to biotechnology. This is another area that's full of potential breakthroughs and exciting advancements.
It is, and he highlights some of the recent breakthroughs we've seen in gene editing and the growing use of AI in drug discovery.
It feels like we're on the cusp of some incredible advancements in healthcare. What specifically is Bill Cara excited about?
He points to the growing sophistication of CRISPR technology, a revolutionary gene editing tool. It's already being used to develop treatments for a wide range of diseases, and the potential is really limitless.
It's amazing to think about the possibilities. It seems like science fiction is becoming reality.
I know, right? And Bill Cara is also excited about the role of AI in drug discovery. AI algorithms can analyze massive amounts of data, identifying potential drug candidates much faster than traditional methods. It's like accelerating the entire research and development process.
So instead of taking years or even decades to develop new treatments, we could potentially see that timeline compressed significantly.
Exactly. He also talks about the continuing evolution of personalized medicine and synthetic biology, both of which hold the potential to transform how we treat and prevent disease.
It's definitely an exciting time to be following the biotech industry. What does Bill Cara have to say about the overall performance of the sector?
He provides a helpful chart of the NYSE Arca Biotechnology Index, ticker symbol BTK, which tracks the performance of the sector as a whole. That chart shows a strong upward trend for the BTK over the past several months.
So for investors looking to capitalize on this wave of innovation, biotech seems like a good bet.
It could be. But as always, it's important to do your own research and understand the risks before making any decisions. No strategy is foolproof.
Right, the market is full of surprises. Does Bill Cara highlight any specific companies in the biotech space?
He does. He mentions Illumina CRISPR Therapeutics and Axum Therapeutics, all companies pushing the boundaries of biotech innovation.
Okay, so we've covered a lot of ground here. From commodities and global markets to bonds, ETFs, and even cutting-edge technologies like AI and biotech. Is there anything else in Bill Cara's report we should touch on?
He actually provides a really interesting perspective on the uranium market. He believes it's poised for significant growth driven by the increasing demand for nuclear power.
That's interesting. I haven't heard much about uranium lately. It feels like that whole sector has been flying under the radar.
It has. But with so many countries focused on reducing their reliance on fossil fuels, nuclear power is gaining momentum as a cleaner alternative, and uranium is the key ingredient in nuclear fuel.
So as demand for nuclear power grows, demand for uranium will grow as well. It's basic supply and demand.
Exactly. And while uranium prices have been fluctuating recently, the overall trend seems to be pointing upward.
That suggests it could be a good time to invest in uranium stocks. What's Bill Cara's take?
He highlights three companies in particular, Cameco NextGen Energy and Uranium Energy Corp. All three are involved in the exploration, production, and processing of uranium.
He even uses his AI assistant to do a detailed comparison of NextGen Energy and Uranium Energy Corp. That's pretty cool.
It is. And his AI assistant found that NextGen Energy appears to be in a stronger financial position than Uranium Energy Corp. But he also points out that both companies operate in a volatile market, so things can change quickly.
I guess that's the nature of investing. You have to be comfortable with uncertainty. What does he have to say about Cameco?
He provides a helpful chart that shows Cameco's stock price peaked back in December and has been in a bearish trend since then. Cameco is the largest uranium producer in North America, so its performance is a pretty good gauge for the overall health of the sector.
So it might be a good idea to wait for a better entry point before jumping into Cameco.
That's one approach. It's always wise to be patient and wait for the right opportunity.
Bill Kerr also dedicates a significant portion of the report to portfolio management. I'm really interested to hear his thoughts on this topic.
He starts by emphasizing the importance of differentiating between quality and price.
That's a key distinction. A stock's price can fluctuate wildly in the short term, driven by emotions and speculation. But a truly high-quality company, one that's built to last, will have strong fundamentals that support long-term growth.
Exactly. And Bill Cara actually quotes Warren Buffett to drive this point home. Buy into
Exactly.
And Bill Cara actually quotes Warren Buffett to drive this point home. Buy into a business that's doing so well an idiot could run it because sooner or later one will.
Classic Buffett. It's about finding those companies that are so well managed, so well positioned in the market that they can withstand any storm.
Right. You're not just buying a stock, you're buying a piece of a business. Bill Cara provides a helpful checklist of factors to assess the quality of a company. Things like strong leadership, solid financials, consistent revenue growth, and a strong reputation in the industry.
Those are all good indicators of a company that's built for the long haul.
He also provides a list of high-quality companies from the Dow Jones Industrial Average, those blue-chip companies based on revenue growth, profitability, and financial strength. It's a great starting point for investors who are looking for those rock-solid businesses.
He's a big believer in diversification too, right?
Absolutely. He always emphasizes spreading those investments across different sectors, asset classes, and geographic regions. It's the age-old wisdom of not putting all your eggs in one basket.
It's about managing risk and building a portfolio that can weather any storm. Bill Cara is also very transparent about his own investment strategy. He talks about his Cara 100 portfolio, that curated list of 100 high-quality companies we discussed earlier.
Yes, he goes into detail about the rationale behind some of the recent additions and removals he's made to that portfolio.
It's like getting a sneak peek into his decision-making process, which is invaluable for those of us who are still learning the ropes.
He explains why he added companies like Los Mondelez International and Nextra Energy. He sees them as having strong fundamentals and being well-positioned for long-term growth.
And on the flip side, he removed companies like Ameresco Marati Therapeutics and Matador Resources due to concerns about growth sustainability, profitability, or environmental risks.
Exactly. He's constantly evaluating those companies and making adjustments as needed. He also spends some time explaining the difference between those two common investing approaches, growth investing and value investing.
For those who might not know, can you give us a quick rundown of what those terms mean?
Growth investors typically focus on companies that are rapidly expanding their revenues and earnings. They're often willing to pay a premium for those high-growth stocks because they believe that growth will continue and those companies will eventually be worth even more. They're essentially betting on the future.
So it's about potential, and sometimes those growth investors are willing to overlook current profitability if they see a clear path to future success.
That's a great way to put it. Value investors, on the other hand, are bargain hunters. They're looking for those diamonds in the rough stocks that are undervalued by the market. They believe those undervalued companies will eventually see their stock price rise as the market recognizes their true worth.
So growth investors are focused on future potential, while value investors are more focused on current fundamentals. Bill Cara makes it clear that both approaches can be successful, but the key is finding the one that aligns with your individual goals and risk tolerance.
Exactly. It's about knowing yourself as an investor. Bill Cara also discusses income investing, which is all about generating a steady stream of income from your investments. This is especially popular with retirees and anyone else who's looking for a reliable source of cash flow.
He highlights some of the typical income-producing investments, including dividend stocks, bonds, and REITs. He also emphasizes that income investors need to be aware of the impact interest rates, central bank policies, and the overall market environment can have on those yields.
Right. And he provides a helpful list of U.S. dividend income indexes to track, including the Dow Jones U.S. Select Dividend Index and the NASDAQ U.S. Dividend Achievers Select Index. Those are great starting points for income-focused investors.
Bill Cara doesn't shy away from more complex topics either. He even provides an overview of options trading. I have to admit, options have always seemed a bit intimidating to me.
They can be complex, but Bill Cara does a good job of explaining the basics. Options are contracts that give the buyer the right, but not the obligation to buy or sell an underlying asset at a certain price within a specific time frame.
So you're essentially making a bet on the future price of an asset.
Right. And he explains that there are two main types of options: calls and puts. A call option gives you the right to buy an asset at a certain price, while a put option gives you the right to sell an asset at a certain price.
So if you think the price of an asset is going to go up, you might buy a call option. And if you think the price is going to go down, you might buy a put option.
Exactly. It's important to understand, though, that options trading can be a very risky strategy. Bill Cara encourages investors to do their research and really understand the complexities before diving in.
He also provides some insight into the current options market, specifically the CBOE options equity put-call ratio, which he sees as a key indicator to watch.
Right. That ratio measures the volume of put options relative to the volume of call options. So if the ratio is high, it means that investors are buying more put options than call options, which suggests a bearish sentiment towards the market.
He also talks about covered call writing. I'm not familiar with that strategy. What is it?
Covered call writing involves selling call options on stock you already own. Essentially, you're betting that stock's price won't rise above a certain level. If you're right, you get to keep the premium from selling those call options. But if you're wrong and the stock price surges, you might have to sell your shares at a lower price than you'd like.
So there's potential for income, but also potential for missed opportunity.
Exactly. It's a trade-off. And Bill Cara emphasizes that it's crucial to understand the risks before implementing this strategy.
Bill Cara also provides a brief overview of those popular investment vehicles, mutual funds, and exchange-traded funds, or ETFs.
He explains those key distinctions like open-end versus closed-end funds and load versus no-load funds. But it's worth noting that he's not a huge fan of mutual funds and ETFs.
I'm curious, why not? It seems like most financial advisors recommend them for diversification and ease of management.
Bill Cara believes they often come with high fees and in many cases underperform the market.
So he prefers a more hands-on approach, focusing on individual stocks and bonds.
He does. He's definitely an advocate for active management. He doesn't stop there, though. He goes on to provide insights into a wide range of international markets, including Canada, South America, Germany, the Netherlands, Norway, Switzerland, the United Kingdom, India, Australia, and New Zealand, Japan, Singapore, Hong Kong, and even China. It's pretty comprehensive.
That's amazing. Yeah, he's really giving investors a global perspective.
He is. And he doesn't just throw out random facts. He dives into specific indexes, ETFs, and companies to watch in each market, highlighting the opportunities and the risks. He emphasizes those key economic drivers, political climates, and currency fluctuations, all the things that investors need to consider.
It's clear that Bill Cara doesn't just talk the talk, he walks the walk. He's put together an incredibly valuable resource for investors of all levels.
I agree. His commitment to investor education and empowerment shines through in everything he does.
And I love that he's not afraid to challenge those conventional Wall Street narratives and encourage investors to think for themselves.
Absolutely. He's a true champion for individual investors. I want to thank Bill Cara again for his incredible work and remind everyone to visit his website, billtara.com, for more insights and resources.
It's a treasure trove of information. Well, that wraps up our deep dive into Bill Cara's Navigator Report number 7. It's always fascinating to get his perspective on the market and to learn from his years of experience.
I always learn something new when we do these deep dives.
Me too. Before we go, I want to leave our listeners with a question to ponder. With so much uncertainty in the world right now, how are you adapting your investment strategy to navigate these choppy waters and capitalize on the opportunities that inevitably arise?
That's a great question to reflect on. Thanks for joining us for this deep dive.
It's been a pleasure, and until next time, happy investing.